You're tuned in to Agriculture Today, and we start our Thursday show with K-State and Washburn law professor Roger McEowen as we continue talking about the top developments in agricultural law and taxation in 2023. Roger, thanks for joining us this morning.
Thanks for having me.
Roger, as we continue talking about these top developments, looking at your top 10 and today, talking about number 7 and number 6. And the first one, number 7, talks about $1 billion biofuel tax fraud conspiracy. And before we hop into that case, what is the renewable fuel standard that goes with this?
Well, the renewable fuel standard, which is basically at the bottom of the pyramid of the scam, was created in 2005 by the Congress, expanded in 2007. And what it does basically is say that certain fuels, and it's the majority of fuels in this country, have to contain a certain amount of renewable fuels in them. And the government, in order to incentivize this, offers lucrative subsidies and tax credits to companies that will convert crops such as beans and corn and other products into the so-called renewable fuels. And, of course, the most common of those is corn ethanol. And so that's what the standard is. It is requiring a certain amount of the fuel in this country to consist of what they refer to as renewable fuels.
And so how does this involve tax fraud?
Well, as part of the renewable fuel standard, biofuel production incentives known as RINs, or Renewable Identification Numbers, RINs. And under the EPA rules, a 38-digit number is designed to track each gallon of ethanol or biodiesel from the producer to the point of sale. Well, the ethanol RINs stay with the fuel until it's pumped by a consumer at the gas station, but biodiesel RINs can be sold separately as credits that can be traded. And so that allows oil refiners who fail to blend the government-mandated amount of biodiesel to buy RINs somewhere else to make up the difference without being fined. But because of that separation of the RINs from the fuel, that allows for the possibility that a RIN price could be negotiated by a biofuel company with an oil refiner with the company using a fake 38-digit number. So then the RIN buyer would then claim to have shipped the biofuel to be refined, but no fuel is actually bought or sold. And so if both the buyer and the seller are in on the scam, what they're doing is they're picking off those taxpayer subsidies, those tax credits, and producing nothing. That's what the scam is.
And Roger, what was this biggest scam that the renewable fuel standards has seen?
Well, we had a case in 2023 prosecuted by the IRS Criminal Investigation Division, and they said it was their number one case of 2023, and also said it's one of the biggest, if not the biggest, tax fraud case in U.S. history involving biofuels. So agriculture is right in the middle of this, unfortunately, and it's the biggest tax crime in the history of the United States. And the perpetrators here created the appearance of biodiesel production and sale to claim the tax credits. And it got away with it for a while. IRS actually paid out more than $511 million in credits to the biodiesel company that then distributed the proceeds among them as the company's owners. So you had 5 people that split this $511 of taxpayer dollars amongst them that they got for these credits. And they got long prison sentences. They pled guilty. They got caught. They pled guilty. And one conspirator got sentenced to 40 years in prison plus over $1 million in restitution and personal financial liability. Another one got 18 years in prison and more than $500 million in restitution. And another one got $338 million in personal financial liability plus the prison sentences. And 3 others were sentenced to 12 and 7 and 6 years in prison each, and respectively, in order to pay over $500 million in restitution combined. So huge tax scam, huge penalties. But this has been a problem with the renewable fuel standard and these RINs for some time. They're just fraught with all kinds of fraud.
And on the topic of tax leads us into our number 6 development for 2023, and this one involving self-employment tax and limited partners. And first, teeing off with, what is a common question you get around self-employment tax planning, Roger?
Well, from a farmer is, how can I avoid paying it? They don't want to pay self-employment tax. In fact, I think how you know when a child is born whether they're going to grow up to be a farmer or not is that they're born with a chip in their head that says thou shalt not pay taxes, and especially thou shalt not pay self-employment taxes. So that's usually the question I get is, what can I do? How can I structure my business? How do I need to be operating to avoid paying self-employment tax? And that's particularly a big deal for older farmers that are fully vested in the Social Security system, and so paying in really doesn't help them anymore. It can be a dangerous strategy for younger farmers that aren't fully vested in the system because in addition to retirement benefits, there are also disability benefits that come along with Social Security. So once they're paid in, then we look at structuring the operation to accomplish a couple of goals. And one of those is to maximize farm program payments. Another one is to minimize tax, and particularly self-employment tax. And the vehicle that we often use to do that is some form of general partnership or a limited liability company that is treated like a partnership for tax purposes, and therefore we have a manager-managed company where we have a designated manager and we have non-managers, or otherwise known as limited partners. Well, the rules set up by the Treasury Department back in 97 and then fully implemented by them from 98, even though Congress said you couldn't finalize the regulations. Congress never gave us a rule on this. So the Treasury and the IRS has just gone on with their proposed regulation. Under that, the details of that proposed regulation, we can have bifurcated interests in a manager-managed LLC where the distributions paid to the limited partners are not subject to self-employment tax. And as a general partnership, as an operating entity, this also gives us benefits from the federal farm program side of things, too. So we get a couple of twin benefits that most farmers often want. Now, we had a big case. My number 6 development is a big case out of the tax court on this issue in 2023. It came in late in 2023, right at the end of November, and it involved an investment firm out east on the East Coast that tried to do this and tried to argue that we set up a state law-defined limited partner interest for our limited partners. They shouldn't have to pay self-employment tax on their distributions. And the tax court said, no, that's not correct. It doesn't matter whether you have a state law-defined limited partner interest. What matters is what you're actually doing. And, oh, by the way, you can't do this if you are a personal services firm, such as an investment company or a hedge fund or something like that, or a CPA or an attorney. You can do it if you're a farmer, but you can't do it if you're a personal services business.
And so what could that look like being set up for a farming operation?
Well, for a farming operation, we would have the general partnership be the operating entity so that we're not limiting ourselves from a payment limitation standpoint. So if I'm a large enough operation and depending on how I receive my subsidies, if I qualify for more than $125,000, which is the general payment limit right now, then what I can do is structure myself as a general partnership, and the limiteds, as well as the generals, I can get multiple payment limits if I qualify for them. And the distributions to my limited partners wouldn't be subject to self-employment tax, which solves that issue for farmers because they don't want to pay self-employment tax. And what the tax court is saying here with this Sorbonne Capital's partner case is they're going to follow the regs. Well, those regs are pretty useful for farmers and ranchers. We like that. So it's a big opinion by the tax court, even though it had nothing to do with agriculture. That regulation that's at issue in the case is very favorable to us in terms of structuring entities for farmers to minimize self-employment tax. That's why that's such a big deal, and that's why it's number 6 on my list.
As we're talking through all this different terminology and talking about taxes, what would you recommend producers do if they're thinking about how can I benefit my operation?
Well, on these issues, this is such a technical matter. They need to talk to their tax counsel, whether that's their CPA, tax preparer, whether it's their tax attorney. This is complicated stuff. This cannot be done on their own. They need to sit down and think through what the current structure is and whether that structure should be modified to provide a tax benefit without, or I would say not without, but consistent with farm program payment limitations if they're in the farm programs, transition planning, succession planning, overall estate planning goals and objectives. It's kind of a piece of the entire puzzle. You can't just take one piece out and ignore the other pieces. They have to all be integrated together. But it is very complex, and I'd say they need to get professional advice on it.
And if people would like to read more of your articles or see 8, 9, and 10 of the top developments in agricultural law and taxation, where can they do that?
These are posted on my blog, which can be accessed on washburnlaw.edu/WALTR, as well as on the Ag Manager website through the Department of Ag Econ at K-State.
Roger, I appreciate you taking the time to join us today and continue to share the top developments in agricultural law and taxation in 2023.
Thank you, Shelby.
That was K-State and Washburn law professor Roger McEowen discussing his recent article titled Top 10 Developments in Agricultural Law and Taxation in 2023, Part 2. And in this article, he discussed his number 6 and 7 of those top 10 developments. If you'd like to read this article, you can do so by going to washburnlaw.edu/WALTR, or you can also find it on agmanager.info. I will link all of these resources in today's show notes on agtoday.net.